Go ahead, Mr. Glennon. We are at the Thursday, September 10th CalHFA board meeting. I guess I might as well give a few housekeeping items. All of the materials that will be covered today in the meeting will be available on the CalHFA website, which is calhfa.ca.gov. And public comments are also posted there as well. And they may be also down in your handout section of your meeting. Nope, I don't see them there today. But we'll go ahead and get started. Thank you.
Thanks, Melissa. Why don't we start with the roll call? I see a lot of faces out there.
Ms. Avila Farias?
Here.
Ms. Avila Farias here. Ms. Gallagher?
Here.
Ms. Gallagher here. Dr. Imbassiani?
Present.
Dr. Imbassiani present. Mr. Gunning?
Here.
Mr. Gunning here. Mr. Hunter?
Here.
Mr. Hunter here. Ms. Johnson Hall?
Here.
Ms. Johnson Hall here. Treasurer Ma?
Here.
Treasurer Ma here. Director Velasquez?
Present.
Director Velasquez present. Secretary Castro Ramirez?
I'm here. Good morning.
Secretary here. Mr. Prince? Mr. Russell? Ms. Sotelo? Okay, I did not hear Mr. Prince, Mr. Russell, or Ms. Sotelo. Also,
I'm sorry, I was on mute. I'm here.
Oh, great, thank you. Ms. Sotelo here. Ms. Campbell?
Here.
Thank you, Ms. Campbell. She's standing in for Ms. Gordon from OPR. And Ms. Bosler from DOF or a delegate? I do not hear a delegate or Ms. Bosler from Department of Finance. Ms. Boatman-Patterson? Here. Ms. Boatman-Patterson here. Chairman, we have a quorum.
Awesome. Well, thank you, Melissa. Why don't we, has everyone had a chance to look through the minutes? Seemed like we were just here together last month. Maybe we weren't. Any questions on the minutes? Any edits to them? Great. Why don't we deem those approved then? Move on to item number 3, Chairman, Executive Director comments. I know the only comment I got is session is over. And while it had a lot of promise, certainly a lot of the housing bills we were all watching didn't make it through. So the only intel I would share is one of the things we're hearing is there won't be a special session. So I don't think they're coming back. But at least some work got done and clearly there's more to do. And I think we all look outside and see that sky and know about wildfires and you see, man, California can't get a break sometimes. It sure seems like it, but we continue to move forward. With that, I'll close out. And Tia, any comments or thoughts for the board?
Yes, sir. I have a couple of housekeeping measures. Agenda item 8, the National Mortgage Settlement Program. We've had discussions on that, and after receiving some comments, we are electing to remove agenda item 8 regarding the National Mortgage Settlement Counseling Intermediaries selection for today's board meeting. We will be republishing the application with the specific criteria upon which applications from the qualified HUD intermediaries will be evaluated and invite all qualified intermediaries to reapply. Following our board meeting today, the treasurer and Director Velasquez and I will be going straight to the CIDLAC board meeting where we will continue our discussions regarding the process that has, we've been having very robust meetings about the bond cap and working to follow the direction of the legislature that was laid out in AB 83 to maximize the efficient use of public subsidy and contain costs. CalHFA's telework policy with the end of CalHFA's emergency COVID-19 telework policy. CalHFA will roll out the agency-wide telework policy on October 1st. Staff who are interested and are asked to submit a request for telework under the new policy guidelines. A couple of upcoming events on September 29th. I will be the panelist for the 5th annual Directors Panel during the San Joaquin Valley Virtual Affordable Housing Summit. standing together by staying apart, and I will be joined by other housing leaders in the state. On October 5th through 9th, the San Diego Housing Federation will be holding their annual conference, which is always great to exchange ideas. And the Director of Legislation and Policy, Francesc Martí, will be a panelist on the session called Federal Housing Policy in a Presidential Election Year During COVID-19 and Black Lives Matter Protests. On October 13th, I will be a panel speaker at the 2020 CAMP annual conference on the topic of embracing anti-racist housing practices. October 27th through 29th is NCSHA's annual conference. And since this is my last year of being the board chair of NCSHA, I highly recommend all of you board members sign up to attend that conference. NCSHA brings together housing finance agencies and industry partners from around the nation. And we're often limited on who can attend because of the travel expenses, but this year's conference is being held virtually. So like I said, I highly encourage you all to apply. There is a lot of good workshops that will be available to you. So I just follow up with Melissa should you want to get registered for the National State Housing Conference annual report. So yeah, that's my report.
I was going to say, are we going to Florida? But I forgot, we're not going anywhere. It's all virtual now, right? So no excuse. It is chock full of information, and it is good to see other board members who do what we do. So I would encourage you and echo Tia's comments that if you haven't done it before, now's a good chance to do that, particularly since it's virtual. All right. Thank you, Tia. Let's move on to item number 4, discussion, recommendation, and possible action to approve the 2021 allocation plan. Tim, I see you there. You ready to go, friend? The floor is yours. The screen is yours, as I should say.
Can someone, can I take the screen, please?
Yep, Tim, you should have it.
Yep, I got it.
You're always in control, Tim.
I don't want to be. All right, so do you guys see my screen? Okay, here we go. Okay, so I'm here today to represent our leadership team to present this agenda item. And I'm truly humbled to be the one who's presenting this because I feel that more than any other initiative, any other project that we have tackled in the last, 5 or 6 years, this one truly has taken the entire village. And I'm just a small part of this. And this one truly has involved the entire agency. So in this presentation, what I like, this is a fairly big topic, so I like to sort of give you a preview of what this presentation is going to do. First, I'm going to go through a brief history of AB 101. And then I'm going to do a brief summary of the resolution. And I'm going to give you an update of the fiscal 19-20 allocation. As it turns out, it was exactly 12 months ago that we came to the board to approve the initial allocation plan in resolution 2019-14. And a lot has happened since, not even thinking about the pandemic, a lot has happened, a lot of hard work by the leadership team, by staff. And I think that I hope the board will find it useful for me to do a little bit of update of what we have accomplished with the allocations to date. So AB 101 was passed and signed by the governor in 2019, and it provided CalHFA with $500 million to finance low and moderate income housing. And this commitment was to be funded over 4 fiscal years. So in the fiscal year that we just passed, 19 and 20, the allocation was $200 million, and that was actually received by CalHFA in December 2019. And in fiscal year 2021, that's the one that we're in now, the original allocation was $95 million. In 2021, $120 million, and 2022 and 23, $85 million. Fast forward a little bit to this year, in AB 89, which was signed by the governor earlier this year as well, which is the main budget bill that that was passed and signed by the governor. Due to the fiscal and budget constraints imposed by COVID-19, AB 89 did reduce the original AB 101 commitments by $250 million. And what you see here is the revised commitment schedule. So the 1920 was already funded. And what it does here is you can see in the 2021, instead of 95, we now only have 50. That's a $45 million reduction. And 21-22, we have 0, and that's a $120 million reduction. And in 22-23, we also have 0, which is an $85 million reduction. AB 89, I'm not a legislative expert, so maybe Frances can chime in, that AB 89 does contain a very atypical provision that stipulates that certain budget cuts would be restored if the state of California were to receive $14 billion in flexible federal assistance by October 15th of 2020. And how this potential restoration will affect AB 101 is that in fiscal 2021, instead of $50 million, we would actually get the original allocation of $95 million. So we would have a restoration of $45 million in this fiscal year. However, in the future, the outlying years of 21 and 22 and 22 and 23, those amounts will remain at 0, and those amounts won't be restored even if the federal assistance were to show up. So in short, I just want to make sure. So in short, this fiscal year we'll either get $50 million or $95 million in this fiscal year. And that's just a brief history of how we get to where we are today. Let me pause there to make sure there's no questions so far. Okay. So moving forward to the actual resolution itself, what the resolution 2017 is doing is that staff is proposing to an allocation plan and asking the board to consider and approve. Staff is proposing to allocate the entire 50 or 95, potentially $95 million for affordable multifamily housing for low and moderate income households to create inclusive communities. So the focus is exclusively on multifamily. When I go and talk about what we have done with the initial allocation of $200 million, you'll see that it was used for both multifamily and single family. So the focus this year is on multifamily. This will support our multifamily lending programs, and the use for our multifamily lending programs will always be aligned with any potential new state tax credit given to us. And this can also be used for innovative financing tools to serve a variety of housing types, not necessarily just tax credit transactions. And it could also be used to complement some of the disaster relief programs that we have. So that's sort of a brief rundown of the actual resolution itself. But before I ask the board to deliberate on the resolution itself, as I mentioned, I'd like to give a brief update on the original allocation that we received in 1920. So as mentioned earlier, in fiscal 1920, we received $200 million of initial allocation, and that was received in December of 2019. $140 million of that was allocated for this mixed income program that the board has heard so much about. As you know, we have brought, Kate and her staff they have brought many projects to the board's approval under this program. We allocated $40 million for single family down payment assistance, and we allocated a little bit more than $19 million for single family accessory dwelling units, and we allocated about $875,000 for a community land trust. So I'm going to go and sort of dive a little deeper into each of these categories to give the board some color of where we are with respect to each of these programs. So first up is the mixed income program. As I mentioned, that we allocate $140 million for this program. And again, this is the board has heard a lot about this project. This project has gotten a lot of buzz in the developer community as well over the last 12 months. This is an over-the-counter program, and I think one of the things you have also heard a lot about is that this sort of really sort of I think that, as some of you guys know, I also have a finance background. So the Fed likes to talk about, the Federal Reserve Bank likes to talk about bringing forward demand sometimes when they lower rates. And we truly feel that this product and this program has brought forward some of the sort of pent-up demand in some of the shovel-ready projects that were looking for funding to kind of cross the finish line. We now have about $144 million in MIP subsidy loan commitments, and that's 20 new construction projects and 3,229 units. And affordability restrictions on those units range from 30% AMI to 120% AMI, and the average AMI was 60%. Next up is the single family down payment assistance program. We allocated $40 million for this program. The board hasn't heard as much about this over the last 12 months. These proceeds were set aside to support lending for things like manufactured housing and single family homes with down payments. Single family homes with accessory dwelling units and leaseholds. We consider these to be non-traditional homeownership opportunities that are just as worthy to support as a single-family detached dwelling. They were also used for housing preservation, for example, FHA's 203K limited home improvement loans. And they were also used to help increase housing supplies for homeowners who are purchasing new construction. And I think that our chairman mentioned about the fire that's raging all around us. This program also supported lending for essential service employees. For veterans who are using our CalHFA VA program, that's very important to us. And for teachers who always had a special soft spot for us. And then in the last year or so, we also added firemen to our program. And I would also add that I highlighted teachers and firemen here, but employees of school districts and employees of fire departments also qualify under this program. And these were also used to support recovery efforts in fire-affected areas as well as we continue to support homeownership in those areas. We project that these funds will be fully committed by the end of this year, at the end of 2020, and we have already funded about 75% of the $40 million. And the next up is the about $19 million for single-family accessory dwelling units. It's a little bit more difficult to transmit excitement, if you will, when we're doing these calls over video. But this is truly one of the most exciting things that we're working on today. And the board knows that we work on a lot of exciting things. We're partnering with Fannie Mae to facilitate and incentivize lending for the construction of ADUs. And as many of the board members know, one of the most difficult things about financing ADUs is leverage and scalability. And as is currently conceived, this program will have about 12-to-1 leverage ratio and will produce about 1,500 units. As some of you guys know, TIA's collaborative model is the potluck. And what is Fannie Mae bringing to the table? Fannie Mae is going to bring to the table a variance that will allow us to allow them to purchase a limited cash out refi to pay off the documented costs of the ADU construction. And this variance will also permit the usage of about 75% of the expected rental income as actually qualifying income. And this is compared to, say, like having a documented rental income for 12 months, which is what's required today. Just to sort of demonstrate sort of the imminence, if you will, of this program. Fannie Mae's have an internal variance approval committee, which is scheduled for September 15th, which is next Tuesday. And they mentioned to me that a potential final approval from their regulator, FHFA, could come as early as middle of October. But here I'm suggesting that we can potentially have that by the end of October. So from their vantage point, they have a schedule of rolling this out, and we're very much encouraged by that. And what are we bringing to the table? And what we're going to bring to the table is we're going to design an ADU program that will incentivize the lenders to make a second lien loan for the construction of ADUs. And our program will also help to mitigate the lenders' risks in making a construction loan. And it will contribute to the borrower's closing costs for the limited cash out refi that's going to come at the end of the construction. I believe a successful execution of this program will produce both leverage and scale to the production of ADUs, which is something that we've been working on for quite some time. And I'll also mention, I forgot to mention this, that this partnership with Fannie Mae is something that we've been working on for 3 or 4 months. And it's not just something that we just started a couple of weeks ago. So speaking of exciting things, I think I mentioned that we don't just work on one exciting thing, we will work on many of them at the same time. We also have a little bit less than $1 million set aside for communal land trusts. And there is a detailed presentation on this by multifamily program, also by Dev. And so I won't try to steal their thunder on this. But this is an alternative model for homeownership that we're also quite excited about. So that concludes my comments on this resolution. I'm happy to take any questions if the board members have them.
Questions from board members? Hi, Fiona, go ahead.
Okay.
Hi. Hey, Tim, the last one, the Community Land Trust, 875. How many homes are supposed to be developed? And remind me how we chose the site in Katati.
Can I punt that to both Tia and the multifamily program folks? Is that okay, Tia?
Sorry. Hi, this is Sheena Ko. There will be 5 homes that will be developed in the city of Katati. And we've been working with the Housing Land Trust of Silicon Valley. She's also on the line today. For item number 9, when we're presenting the AB 101 Innovative Financing, you'll hear a little bit more about the project.
It's a disaster recovery area as well. That was one of the factors that went in. And Deb and I have been talking about this project for a couple of years now. So they'll give a really good presentation on this later on in it. But this is actually a really exciting alternative model for the new construction of single family homes. And so it is very, very exciting. So we'll let Deb do their presentation.
Okay, I'll wait. Thanks.
Any other questions from board members? Oh, hi,
Yeah,
Eileen.
Hi. I have a question for Tim on the ADUs. You know, one of the things I've been seeing lately, you know, you apparently can buy a house on Amazon, ranging, you know, these little mini houses in people's yards from $7,000 to $120,000 in ranges. Are we using any of those kind of scaled products? You know, that would seem to be an efficiency than custom construction. I was curious about that.
Well, first of all, Eileen, did you see the article today on how Amazon is produced? You know, one of the things I order a lot myself is Amazon Basics, and there's a big article on, at least I saw on CNN, about how these Amazon Basic products are actually catching on fire.
I saw it.
But at any rate, I don't think that we are going to prohibit anyone from using manufactured housing to lower the cost of ADU. I think that's going to be completely permitted as long as the lender is willing to make a loan like that. And that kind of stuff is happening a lot, as you mentioned, during this pandemic. People are looking for another unit away from the kids so they can have a little peace and quiet to do calls like just like this. So yeah, that would be completely permitted in our thinking of this program. They can use manufactured housing to lower their costs, so then they can just plop it down and have someone run the wires and lay the foundation. Totally permitted.
Thanks.
Tim, this is Lourdes. I had a question regarding the MIP loans. You mentioned that about just under 3,229 units have been created. And so are you all sort of capturing the location of these units? And, you know, given some of the conversations we've had in the past about just how important it is to develop in areas that allow for housing to be connected to jobs or transit and other sort of amenities. Just wondering if that's the level of information that is also being collected for this program and for these units that have been created.
I'll address at a high level, and if need be, Kay can jump in. Yes, we're definitely capturing data like that. And I would also mention, Madam Secretary, that you know, one of our jobs is to sort of connect the dots in state government. And you might know that the Treasurer's Office has developed this opportunity mapping methodology. And when we developed the MIP program a year ago, we did have a lot of conversations about what that opportunity mapping methodology is guiding us in terms of our programs. And sort of how do we incentivize, let's say, building affordable housing in the terms of the methodology in high resource areas. That's one way for us to create meaningful affordable housing that could also create opportunities for the residents. And as you know, there's a lot of conversations about food deserts and all this stuff. And in some sense, that mapping sort of encapsulates a lot of that into these high resource areas as an example of that.
Tim, this is Tina. I had a question for you. First, thank you for your report, which is always so wonderfully comprehensive. You tend to think of everything, which is wonderful. I think what I saw early in your report is that there will be 50 million that will go to multifamily. Of course, there is a potential for an additional pot to be restored. I'm just wondering if part of that restoration would include single family, if we do get it, which I think would be particularly important in light of the fact that that is still something based on market indicators that is still very much needed, and is specifically very much needed in the counties that I represent in Riverside and San Bernardino County. So I'm just wondering what the thought is for the future if those funds are ultimately restored.
I think thank you, Tina. I think our conversations have been well, first of all, I think that the probability of that restoration seems more bleak as the days wear on. But our conversation had been to, if we were to get the restoration, to continue to focus on multifamily. And I think that while it's not shown here, our good work in homeownership in terms of supporting non-traditional homeownership and also the essential employees, that's not going to stop, I think, if we don't get some part of these restoration dollars. We're going to continue to find other resources to do that.
Thank you.
Any other board members have questions, comments? Awesome, Tim. I thought we were going to hear a baseball analogy, but that was pretty good anyway. Is there a motion to approve Resolution 20-17?
This is Tina Johnson Hall. I so moved.
Is there a second?
I'll second. Dr. Bassiani seconds.
Okay, awesome. There's a motion and a second. Roll call, please.
Okay. Ms. Avila Farias?
Yes.
Ms. Avila Farias, yes. Ms. Gallagher?
Yes.
Ms. Gallagher, yes. Dr. Imbasciani?
Yes.
Dr. Imbasciani, yes. Mr. Gunning?
Yes.
Mr. Gunning, yes. Mr. Hunter?
Yes.
Mr. Hunter, yes. Ms. Johnson Hall?
Yes.
Treasurer Ma?
Yes.
Treasurer Ma, yes.
Yes.
Director Velasquez?
Yes.
Director, yes. Secretary Castro Ramirez?
Yes.
Secretary, yes. Mr. Prince? I don't think he's on the line yet. Has Mr. Russell joined us? Nope. Ms. Otello?
Yes.
Ms. Otello, yes. Chairman, we have approved resolution 20-17.
Awesome. Thank you, Melissa. All right. It appears that we've received a number of requests to do public comments early because many of those would like to thank us for redoing the selection process for the HUD intermediary. So if you'll indulge me, I think we're going to step down to item number 12, the public comment opportunity. And Melissa, guide me here, but allow folks from the public to comment at this time.
Yes, I'd be happy to. We did receive one written comment from Frederick Wuscher from Strum Washer and Wuscher, representing Neighborhood Stabilization Corporation. That document can be read by the public. It is included in the handout section on the control panel for the meeting today. It is also posted on the CalHFA website. I do believe we have a number of folks who are interested in speaking orally, and so I would ask those folks to raise their hand, and I will let Courtney then call on those folks, and she will unmute your mics when she calls on you. Go ahead, Courtney.
Melissa, and we're only allowing 3 minutes per person. Are we going to time limit on comments?
That's correct. Thank you. We do have a 3-minute time limit. We do ask that in order to make the meeting run efficiently, if you could be concise and brief in your comments and keep them to much less than 3 minutes, we'd appreciate that. Thank you. Courtney?
Okay, Bruce, if you'd like to make a comment, you just need to unmute yourself and go ahead.
Thank you very much. I appreciate the opportunity, and thank you for moving up the comment period. So we have a number of people who are on the line from who are the participants in the NSC program. NSC is the largest HUD certified counseling agency in the country. We do about 30% of all the counseling in the country, where there's 1,700 counseling agencies. And obviously, we've had a huge presence in California. During the mortgage crisis, we were the ones, we did 34 massive Save the Dream events where we helped tens of thousands of homeowners in California save their homes. And we worked with the Keep Your Home California program. So we did that, and now we're doing the purchase side. So, we feel very strongly about the submission that we did. And we appreciate the board and the staff for opening it back up and to putting specific criteria in place. We think that we could we know we could have a huge impact within the state. One of the things that you might want to look at as you're going through in the last board meeting, you said that for someone who's doing a workshop, a client who's doing a workshop and individual counseling and follow-up, that would be paid at $1,500 per client. In our proposal, we said that would be at $750. So you might want to look at that to see, you get the more people to really get the assistance out there. We said we can do over 12,000 people, households a year. We think we can do absolutely more than that. So we, do appreciate the opportunity to have the specific criteria in place that we can respond to, because we've done it really well with HUD. We've never had any findings against us to do that. And we also would like you to make clear how important it is we work with other HSCs, housing counseling organizations in the state. Because clearly we have the network to do it, but we want to support the other counseling agencies out there. We're a HUD-approved trainer. We would do that all for free. So I know you're not going to make any of the decisions on any of the applications, and we just want a fair and transparent process for that evaluation. And I know it's not always easy to back off what the initial decisions or the recommendations have been. So we appreciate you taking the opportunity to take a step back and give us the opportunity to really address the issues and have a transparent process. But we're big players out there, and we look forward to working with you in the state of California. So thank you for the opportunity, and I think there might be some other people on the call who might want to say something, and if not, that's fine, because we had a lot of people who wanted to voice their opinion in support of what we're doing. So again, thank you for the opportunity, and we just ask you just to stay on top of it, to look at the criteria to make sure it's a fair and transparent process. That's all that we're asking for on that. So Ray, thank you, everybody. I appreciate it.
Great, thank you. Courtney, who's next?
All right, Sherry, I am going to unmute you, and you can unmute yourself and speak to the board.
Hi, thank you so much. My name is Cherie Green, and I'm a part of the Neighborhood Assistance Corporation of America, also known as NACA. And I am a NACA member, and I was approved through the program, and I'm currently in the housing search. NACA has been a great asset to me and a great counseling program for me. And they have made it possible for me to be able to purchase a home due to their low interest rates and great incentives like no PMI down payment or closing costs. How is CalHFA working with NACA to broaden their exposure in California? And what is CalHFA doing to make housing more affordable and not allowing investors and flippers to buy up all of the affordable homes with their cash offers? As you know, the market in California is horrible for low to moderate income housing, and it's hard to find good housing out there, and the flippers are basically buying things out. So what are you doing for that? And last, how do you define low to moderate salary limits? What are those limits? If anyone can explain and answer those questions. I know I had a lot, but thank you.
I think we can do the back part of that, Tia, but I don't know about the first part. I don't think that's our role.
This is just public comment, so we'll just listen to the public comment, sir.
Thank you. Courtney?
Hey, Amber, you can unmute yourself and provide comment if you wish. Okay.
Hi, thank you. My name is Amber McNeil, and I am also a NACA member. And I just want to shout out and thank Bruce for all the hard work that he's doing for us as members. You know, living in California and as a single woman on a salary of $52,000 a year, it has been really difficult to find affordable housing. And so I just want to share that NACA has been the bridge to being able to become a homeowner. I'm currently qualified and searching for a home right now, which although, you know, NACA has been helpful, the housing process, the housing cost has been really high. And so that's currently my challenge of finding something that I can afford. And I know that a lot of different, there are some grant programs that are available, but, you know, it's sometimes hard to access those funds when working with NACA. And so it seems like, you know, there's some barriers that are put in place to home ownership, even though I have a great rate and I've been approved for a decent amount. I think some grant money would be helpful to either buy down interest rates or help with repair costs, because a lot of the homes that are in my price range do have a lot of high repair costs. And NACA is great about helping you go through the inspection process and coming up with a list of required repairs. but sometimes accessing those funds to help with repairs is challenging. So I do just want to thank NACA, because without NACA, I wouldn't even be able to be searching for a home. So that's all. Thank you.
Thank you, Amber. Courtney?
Okay, Malika, if you unmute your phone, you may speak to the board.
Thank you so much. Good morning, board members. Thank you so much for allowing me to speak, and to my amazing CEO, Bruce Marks. I am an in-house agent with NACA, and I have helped numerous members achieve their dream of home ownership. As a few people have already spoken before me and have stated how expensive it is to make a home purchase here in Los Angeles, what I find is that a lot of our members, because of the high costs, are still shut out of their dream of home ownership because they may not be able to afford in the area that they would like to live in here in Southern California. And any type of down payment assistance that we can use to work with the program would greatly assist our members in becoming homeowners. NACA is amazing in that it allows our members to purchase multifamily housing, as well as purchase homes that have accessory dwelling units. And the issues a lot of times that we have is the affordability, because the home purchases or the home sales prices are really high, but the rental incomes are too low to bridge the gap between affordability of making that purchase. So what would be wonderful is if our members could access some type of down payment assistance to assist them in bridging that gap. I do have a member right now who is using a housing program voucher, I believe, which is another great opportunity NACA allows, where members can access Section 8 vouchers to become homeowners. If we are able to, allow more of our members to access those types of programs to become homeowners as well, I think that would allow for great opportunity to see more people become homeowners here in Los Angeles. So I hope we're able to, create some type of working joint venture between NACA and this program in order to assist more members here. And I thank you once again so much for allowing me to speak today.
Thanks, Malika.
Okay.
Thank you.
Erica Brown, do you have audio that you can turn on? Okay, it doesn't look like it. We'll move to Michelle. If you unmute yourself, you can go ahead and make your comment.
Hello, my name is Michelle Farrar, and I am a NACA member, and I'm in the housing purchase portion of it. So I'm just waiting for my home to close escrow. And I just wanted to thank NACA. Malika, who spoke, is my in-house NACA agent. She was amazing and in the process of helping me find a home. And Sharon is my mortgage counselor. Both of them together have made this process really, it helped me because it was hard and I didn't know how to navigate it, but working with both of them has helped. And I'm just grateful to NACA because without this program, I wouldn't have been in position to be able to buy. So I just wanted to say thank you, and you guys are doing amazing.
Okay, Dion, if you would like to make your comment, go ahead.
Yes, thank you very much. I'm also a NACA member, and I'm in the home search process, and I'm very fortunate. And I come from like many recovery. I've had including bankruptcy and divorce, and there are many people who would have thought it was impossible to become a homeowner in California. So I'm looking at one of those opportunities where, had it not been for NACA, I would not even be in the position to even be considered. I'd be like many of my folks, and like many in California, looking to move out of California, moving to Otisburg, South Dakota somewhere to try to find some decent housing, right? But I'm in a position right now to purchase a home. But like the other members have mentioned, it's great to be qualified, but you're still in a position where you can't qualify because all the housing costs are through the roof. Even for a 3-bedroom, 1 bath, you're looking at $400,000. So all these flippers and investors are parsing us out. So if there's any way we could support even more the NACA program by offering some additional resources to mitigate that opportunity of getting outbid. I've been outbid 4 times already, and it's getting discouraging because these investors are coming and swooping up all the property, and I have a limit. But if we have some additional resources, saying if you're in a certain area, to keep people from moving out of California, the gentrification and the generational gap with people, forcing people, mainly of color, of not being homeowners, those resources would be ideal. Some additional funding from down payment or something to help us even more so. Although I'm confident that it can happen, but I know I'm not the only one that are struggling with being priced out and forcing to say, maybe I shouldn't be looking in California anymore, and we don't want to think like that. So I really want to really advocate for NACA, but also advocate for litigation to help us support those individuals who are still struggling, even though they have the NACA support. So I thank you for the opportunity. I appreciate it, and I appreciate the opportunity to share.
Awesome. Thank you, Dion.
Okay, we have Erica. Erica, go ahead with your comment.
Thank you. Good morning, everyone. My name is Erica Brown, and I am also a NACA member. And I would just like to mention that I see on the previous slides, you guys were mentioning a priority to multifamily units. My husband and I, when we first joined NACA, our goal was to get a multifamily unit. However, because of the cost of the housing and not having the proper resources for additional assistance, that did not allow us to get a multifamily unit. So we had to settle for a single family unit, which we are happy with. However, that wasn't our original goal. We are living, we're currently renting. We are currently in escrow for a property that's only about 2 miles away from where we're renting. However, it took us such a long time to get a home, even in the area in which we were raised in, because we were constantly being outbid by cash offers or just a lot of different buyers who were looking for investment property, and they didn't live in the areas in which they were buying these properties. But here, my husband and I, we were trying to find a property that was in the area in which we grew up in, but we weren't able to. We don't want to move out of California either. It is just completely unaffordable. But we would definitely, a lot of myself and other members in the NACA program would definitely benefit from a lot of different resources to help with being able to afford a home in California. So we do thank the NACA program. Right now, we were able to lock in a 1% interest rate, which we would have never been able to do. We would have never been able to be homeowners with some of the challenges on our credit due to mistakes made in the past. But because of NACA, we really are being able to say that we are finally becoming homeowners that we really honestly did not see within the near future. So additional resources as far as helping with down payment assistance and closing costs and all that stuff, we would really greatly appreciate just to make living in California a little bit more affordable. So thank you.
Awesome. Thank you, Erica. Courtney, anyone else?
Yes. Jay, if you have a comment, go ahead.
Yeah. Hi. Morning. My name is Jay Suhu. I'm also a NACA member. I would like to first thank Bruce, the founder of NACA, and also all of the people who work at NACA. They're amazing. And, you know, just like everyone else has shared, without this program, I would never have been able to purchase a home, even though I work as an engineer. With my salary and high prices, I still continually got outbid by multiple investors who came and they can just throw down a cash offer and take the property. One thing I would like to ask is what type of funding you guys have available for, because I mean, even to purchase a property, you have to spend money to repair. I was not able to finance my repairs for my property. So I'm wondering what sort of funding you guys have available for just people who need to repair the property. Thank you.
All right, thank you, Jay.
Okay, we have Brandy. Brandy, you can go ahead with your comment.
Thank you so much. My name is Brandy Barnes. I'm also a member, and I'm in the Southern California area in the Inland Empire. I'm also a non-priority member. And I also want to thank NACA for affording me the opportunity to purchase a home, mostly because of how they factor in your affordability. And that was a huge difference for me, just showing that I'm able to afford, and the way they factor in student loans, all those things kind of helped me out. Now, I know people are talking about investors, and what I found due to COVID is I find a lot of families are moving in together and they're able to offer 20, 30. I've even been outbid by 40,000 over asking price, and even them offering money over appraisal. And so that has been a huge challenge. And what I've found as my saving grace is to just go with a new build, which is with D.R. Horton. And that has been a huge difference for me. Now, I have concerns about the non-priority and versus priority, because I noticed that a lot of people are migrating to the Inland Empire because houses are a little bit more affordable than Los Angeles. And due to that migration, I think that they're able to, well, as the seller's market, they're able to really boost up those prices on the houses, knowing that it's going to be above appraisal. So what I found to be the most helpful for me, and I don't know if this is relevant to this group, is that the post-qualification webinar with Eric Exum was amazing, and it was very helpful to navigate through the next steps. So I would say, maybe looking at the non-priority versus priority again in California, looking at the changes in migration in terms of people moving to the Inland Empire, and perhaps making that post-qualification webinar mandatory so that it really helps members figure out how to navigate through next steps. Thank you.
Okay. Wadaya?
Courtney, I'm going to interrupt you for a moment. How many speakers do you have lined up?
One.
Okay.
And I'm pretty sure I'm saying your name wrong, but Wadaya Penn, if you would like to make a comment, you may go ahead.
Yes. Let me mute myself over here. My name is Wadia Penn. I'm also a NACA member. And I know that the resounding feedback that you're hearing is about the difficulty to afford housing in the Los Angeles market due to outside investors coming in to our communities, buying the properties, raising the prices, and making it very hard for local residents to be able to attain housing, and how NACA has made it possible for us to compete in this real estate market. I just wanted to once again emphasize the importance of this program and what it offers people in the community in terms of the ability to live within our communities, to invest in our communities, and to have long-term stake in our communities that could ultimately trickle over into making sure that, these communities are upkept, that there are people sending their children to the schools in the communities, that we're investing in the local businesses in the communities. And that all starts with making sure that we have homeowners who have a vested interest in the communities in which they're buying. Just wanted to add that.
Awesome, thank you. So Courtney, does that close it out for us?
That does close it out.
All right, well, we certainly thank everyone for those comments. Let's move into the agenda and moving on to item number 5, which is an update on Assembly Bill 69. Frances, I think this one is yours.
Mr. Chair, Treasurer Ma is
yes.
Yes,
Treasurer Ma.
Yeah, since we provided technical support on this bill, I'm gonna abstain, so I'm just gonna log off and join you at the next item.
All right, we'll tell you when we're back. Thank you, Fiona.
Okay, thank you.
Okay. Hello, Chairman, board members, colleagues. At the August 13th board meeting, I reported to all of you that AB 69 by Assemblymember Ting was being considered by the legislature and would adversely affect CalHFA's bond covenants, our credit ratings, and consequently our ability to finance affordable housing. And just to recap, AB 69 would create a new program at the State Treasurer's Office that would offer loan guarantees for accessory dwelling unit construction, and it would have CalHFA issue revenue bonds to finance such loan guarantees. So since then, since I last spoke to you, CalHFA has continued to provide technical assistance to authors and has continued to transmit our strong concerns with this bill. The California Department of Finance also publicly posted its analysis in opposition, stating that it, open quote, results in significant ongoing costs, not part of the 2020 Budget Act, creates unsustainable cost pressures outside the direct control of the administration, and poses legal concerns, end quote. So despite this, the legislature has decided to move forward with AB 69 and has not made any changes to address CalHFA and or DOF's concerns. The only amendment to the bill since I spoke before the board on August 13th only restricts applicants to owner-occupants, which doesn't address our concerns. So AB 69 passed the Senate on August 30th, and then it passed the Assembly on concurrence on August 31st with I think there were 45 minutes left to end the session. It was about 11:15 when they passed it. So now the governor must sign or veto this bill by September 30th. So that's where we're at. So in the board packet, we have included a staff report that includes a detailed analysis of this bill's problems. I'm not going to get into all of them in detail, but as a follow-up to my statement on August 13th, we have prepared a resolution that summarizes these problems and requests that this bill be vetoed. I will now read this resolution into the record. So resolution number 20-18, opposing Assembly Bill 69. Whereas Health and Safety Code Article 50901 states the California Housing Finance Agency shall be administered by a board of directors, and whereas the board shall authorize any sale of obligations or securities or other debt obligations and shall approve other major contractual agreements. Any other contractual agreements or debt obligations may be approved by the executive director pursuant to regulations of the board. And whereas Health and Safety Code Article 51000.1 states that no officer or division of state government shall transfer any sums of money from any fund or account of the agency except as may be ordered or authorized by either of the following: the executive director of the agency or his or her designee, the designated trustee pursuant to authority contained in appropriate adopted resolutions pertaining to notes or bonds issued by the agency, and whereas the agency shall exercise its powers with due regard for the right of the holders of bonds of the agency at any time outstanding, and nothing in or done pursuant to this section shall in any way limit, restrict, or alter the obligation or powers of the agency or any member, officer, or representative of the agency or the treasurer to carry out and perform in every detail each and every covenant, agreement, or contract at any time made or entered into on behalf of the agency with respect to its bonds or its benefits or the security of the holders of the bonds. And whereas pursuant to Health and Safety Code, Article 51373, the state of California has pledged that it will not limit or alter the rights vested in the agency to fulfill the terms of any agreements made with the holders thereof, or in any way impair the rights and remedies of such holders, and such pledge is included in the agency's agreement with the holders of its notes or bonds. And whereas Assembly Bill 69, as proposed by Assemblymember Ting, mandates the agency to issue revenue bonds for accessory dwelling unit loan guarantee program administered at the Office of the State Treasurer, repayable through the California Housing Finance Fund in violation of the covenants of the agency to its bondholders and of the agency's fiscal independence, thus inflicting harm on the agency's credit ratings and its ability to finance affordable housing. And whereas the California Department of Finance opposes AB 69 because it results in significant ongoing costs not part of the 2020 Budget Act, creates unsustainable cost pressures outside the direct control of the administration, and poses legal concerns, according to the department's August 25th, 2020 analysis of the bill. Now, therefore, be it resolved by the Board of Directors of the California Housing Finance Agency as follows. 1, the board finds and declares that the above recitals to be factually true and correct. And 2, the board opposes AB 69 as proposed by Assemblymember Ting and requests that the governor veto the legislation. Staff is directed to forward a copy of this resolution to the governor. So that is the resolution. But given the tight timing between the bill passing the legislature, being prepared to be sent to the governor's desk, and the short time that the governor has to act on the bill, CalHFA staff has already requested to the governor's office that this bill be vetoed, so no board action on this resolution will be required today. So Chairman, that concludes my statement.
Awesome. Thank you, Frances. I will tell Fiona we're back.
Can I ask a question first? So did I hear that correctly?
Yes, go ahead, please.
So the expectation that the legislation will be vetoed by the governor and the issue goes away, did I hear that correctly?
You never quite know.
We don't know. We can't anticipate what the governor may do, but we feel we have a very strong analysis and a strong recommendation that it be opposed.
Okay. And if he does sign it, then what?
We'll be back getting some advice from you board members.
All right, fair enough. Thank you.
Awesome.
I have a question.
Yeah, go ahead, Jonathan.
I just because I don't know why I have this question, but I do have this question because, well, I do know why. It's because so far in my experience on the board, we've never taken a position on legislation. So I just want clarity from council that this is appropriate for us to do.
Well, Jonathan, though, we're not asking you guys to take any action because the timing, etc. In addition, we understand that this is a very awkward circumstance to put the board members in. The reason why we even brought this to you all is because of what we believe is our fiduciary duty to alert the board what's going on in a very direct and matter-of-fact way. But we are not seeking any board action on this because of the kind of awkward position that puts you on and because of the timing of us having already delivered this message to the governor's office.
Thank you for that clarification. I mean, I was more than glad to take a position. I certainly support the concern, but I just wanted that clarification. So thanks.
I don't think in the history of the organization we've ever seen legislation quite like this.
Fiona's dealing with something else. Okay, let's move on to item number 6, our multifamily lending guidelines. Sheena, is that you?
No, that's me, Chair Gunning. It's Kate.
Hi, Kate.
Hi, good morning. Good morning, Chair Gunning and members of the board. My name is Kate Ferguson. I am the Director of Multifamily Programs here at CalHFA. At the last board meeting, a new resolution number 20-16 was passed, and this resolution increased the delegated approval authority of the executive director to 15 million. In the context of that decision, today I'd like to briefly update the board on our approval process for multifamily loans. As you know, over the past year or 18 months, we have bolstered existing policies, guidelines, and procedures to ensure that our approval process is focused on the necessary and relevant due diligence and analysis. Next slide. The approval process, oh, sorry, Courtney, that's too far through. Go back 2 slides. Okay, there you go. Okay, good. Okay, the loan approval process flows down from the lending authority. I'm just going to keep going. Delegated to the executive director by 2 primary board resolutions. Resolution 2016, which I just mentioned, passed at the last board meeting and increased the executive director's delegated authority for loans under our first lien permanent loan program to 15 million. Resolution 19-02 gives separate delegated authority to the executive director to approve loans under our mixed income program. These are the 2 primary board resolutions we refer to most often in multifamily. Loans which do not meet the delegated authorities granted under these resolutions come to the board for approval. Sheena will be presenting one such loan for your approval in a few minutes. But first, I wanted to discuss, next slide, please, our policies and underwriting standards. So we've discussed the multifamily loan underwriting standards and reference manual, the USRM, before. The USRM is a living document which defines the underwriting guidelines, credit policy, and the roles and responsibilities of staff in the credit procedures. It is managed by the credit officer, Sheena Coe, who recommends and presents potential changes to the document to the Senior Loan Committee on an ongoing basis. Changes to the USRMs might be motivated by a variety of influences, including market and industry standards and norms, CalHFA's risk appetite, or new lending products, etc. Over the last year, an in-depth review and update of the USRMs has been done and approved by the Senior Loan Committee. Maintaining this document is a top priority as it gives a clear roadmap of our lending parameters to all the members of the lending team, including loan officers and underwriters, loan administration staff, and our legal team. The individual program term sheets define program-specific guidelines, while the USRMs define the overall credit culture of multifamily lending. Next slide, please. So this slide you've seen before. It lays out the development, financing, approval, and funding cycles for a standard deal. I wanted to point out to the board that there are 2 times when a full analysis of a project loan is underwritten by the multifamily team. Both are designated by arrows, big orange arrows on the slide. As you all know, because CalHFA is a permanent lender, we're making our commitment to fund the permanent loan prior to the closing of the construction loan. This can be 3 or more years prior to the actual conversion of a project from its construction to permanent phase. Therefore, we also do a complete reanalysis of the project prior to permanent conversion. Next slide, please. There are three primary approval processes prior to any multifamily permanent loan closing. The first two are prior to the construction loan closing, and the final one is prior to the permanent loan conversion. This slide gives some detail related to these three approvals. The first is the initial loan approval, which generally is done to facilitate an application to CIDLAC or TCAC. At this time, a pro forma analysis is done on the project economics. However, much of the due diligence is not in hand at the time. We do require a market study at this stage to ensure that the project is meeting a need and that it will be competitive. The market study is also imperative to our analysis of the affordability and rental structure of a deal. The final loan commitment approval takes place 2 to 6 months later and happens once all due diligence has been received and once the project has received an allocation of bonds or tax credits if that is necessary. The final staff report is what you will see in Sheena's presentation on the One Lake project today. Most important to the underwriting process at this stage is the identification of the strengths and weaknesses of the project, along with mitigants to the weaknesses so that the Senior Loan Committee can accurately assess the risk. In every staff report, the exceptions to policy, the USRMs, and the program term sheet are outlined in Section 8. This again is to lay out a clear picture for the approvals of the project risk. With the approval of the final staff report, the legal team works to develop the final commitment letter and loan documents. Finally, at conversion, which is 2 to 4 years later, after construction is complete and the property is leased up, the loan officer does a full analysis of the completed project to ensure it meets all of the underwritten benchmarks prior to close of the permanent loan. Any deviations are subject to approval by the Senior Loan Committee as necessary. Next slide, please. This final slide I wanted to show you because I think you'll see on our deals as they come through to you, I'm sure you've seen in the past, that there generally is an exception or two in almost every loan. And these are exceptions to our policies, USRMs, or the program term sheets. And while we work to structure every loan to reflect all of our guidelines and policies, we work, as you all know, within an industry that has many influences over the structuring of deals, and they may vary from our own expectations. You'll always find exceptions to policies, as I said, in the Section 8 of the staff report. Exceptions are an inherent part of a competitive and/or unstable market that is constantly in change. And we have seen both of those right in California over the past year, and we will continue probably for the next 12 to 24 months. Our goal is always to understand and analyze the source and purpose of a borrower's request for an exception and to mitigate any additional risk that an exception might bring to the agency. This slide is merely a snapshot of our exception tracking, and this is only for our mixed income program, the projects in that program. We do this for all of our projects, regardless of what program they're in. But we track the exceptions for reference and to ensure that we're responding to the market changes at the program level as well. As you know, the executive director has the authority to refer any exception to the board for approval, as Tia has done in the past. I'm sorry, as Tia has done in the past. And this was done last year in December. We presented for 4 deals in the mixed income program that we're going over the maximum loan amount per deal. Tia brought those back to the board. We presented them in December for approval, and that was for transparency and consideration. So what I wanted to do today was just, given that in our last board meeting, you did give increased authority for approval outside of the board, I want to make sure that everybody understood what our process is, what guidelines we're underwriting to, and how we're managing that on a day-to-day basis. So I'd be happy to take any questions at this point.
Delilah, yep.
Thank you, Mr. Chair. I just wanted to thank the staff for this presentation. It is so great to have it be put on paper and be presented so clearly. I really hope that, I'm not sure if it's in one of the handouts that we received via email, but if you could just please make sure to distribute that to the board via email, I think it is very helpful for us for, just understanding what the team goes through before they present a project to the board. So thank you for this.
You're most welcome.
Any other comments or questions from board members? Okay. Is Shayna going next, Kate?
Yes, sir.
Yes, sir.
That's very helpful. Thank you.
Okay, good morning, Chair Gunning and members of the board. My name is Sheena Ko, and I am the multifamily credit officer here at CalHFA. Can you guys hear me okay? I do have to put my mask on because I have my colleague here with me, Ruth Bikili, the multifamily loan officer. So I just want to make sure that we're practicing, this social distancing. Okay, great. Again, I am here today to present the One Lake family apartment for approval by the board. Next slide, please. Oh, Courtney, you're good, actually. Go back to that slide. Sorry about that. Go back to the second slide. Okay, so One Lake family apartment is a 190-unit affordable family project to be located in Fairfield in Solana County. The project affordability will include 94 units that will be restricted at or below 50% of AMI, 94 units that will be restricted at or below 70% of AMI, and 2 managers units, which will also be restricted at or below 120% of AMI. One Lake family apartment is part of a 390-acre master planned community known as One Lake. When completed, the community will include 2,226 homes, retail, shopping, parks, and recreational areas with a lake. This development is in a moderate resource area. Meta Housing Corporation is the developer and has developed 76 multifamily housing projects totaling over 6,000 units across California, 10 of which are currently under construction. 12 of their completed projects are currently in the CalHFA portfolio. The One Lake project will be managed by WSH Management, Inc., which has been in operation for 18 years and has completed lease up of 32 LIHTC properties. WSH currently has 3,311 units under management, including 2,970 LIHTC units. They currently manage 5 projects in CalHFA's portfolio. Slide number 3. The project site will be 5.59 acres and is zoned for high density residential use. Here is a view west from One Lake Drive. Next slide, number 4, please. Here is another view south of One Lake Drive. As previously stated, the project will consist of 190 elevator service units with 23 one-bedroom units, 72 two-bedroom units, and 89 three-bedroom units in a 4-story building. The building will have standard amenities and include 277 on-site parking spaces. Next slide, number 5, please. The project is seeking a $25,780,000 permanent first lien loan and $14,255,000 in MIP subordinate debt from CalHFA. CalHFA's first lien loan is structured as a balloon loan with an amortization of 40 years and a loan maturity due at the end of 17 years. CalHFA has underwritten the permanent loan at an estimated interest rate of 4.05, which includes a 25 basis point cushion to the current CalHFA rate. The MIP loan will be structured as a residual receipt loan with a 2.75 simple interest rate. And the MIP loan will be coterminous with the first lien loan, which will be due at year 17. Chase will provide a construction tax-exempt loan of $45.5 million and a taxable loan of $27.4 million. The estimated deferred developer's fee is $5.7 million, which will be fully repaid by year 15. The estimated total development cost is approximately $451,000 per unit, and the total state subsidy per unit is approximately $145,000 per unit, which is inclusive of $70,000 per unit in state tax credits and $75,000 per unit in a MIP subsidy. Next slide, number 6, please. Here on this slide, we will outline the strengths and the weaknesses and mitigants. First, project strengths includes the tax credit equity generated by the project, which will fund approximately 47% of total development costs. The price per credit for both the federal and state tax credits are expected to be 92 cents and 90 cents on the dollar. Secondly, there is a very strong demand for affordable housing in the area, as evidenced by both the appraisal and the market study, which came up with an average capture rate of 15.4% within the primary market area. And thirdly, the project is expected to reach full lease up within 6 months of completion. The rents will range between 46% to 69% of market rents, which is definitely an indicative of a project that is within a strong market dynamic. As Kate noted in her presentation, one of our underwriting discipline is the development of an exit analysis on every deal. This analysis addresses the refinance capacity of the project based on future cash flows and some market assumptions, which in this case, we typically assume that the interest rate will be 2% above the current interest rate and 3% above the current capture rate. Based on the agency's ability to repay the outstanding CalHFA first lien loan, however, is expecting a MIP subsidy balance of approximately $18.2 million. To the extent that a refinance is insufficient to repay or fully repay the MIP loan, it is contemplated that any remaining balance will be paid from a general partner contribution as part of the final closeout of the partnership obligations to allow a resyndication. Next slide, number 7, please. As Kate discussed in her presentation, we are constantly tracking the exceptions to the following, which includes the CalHFA policy, CalHFA's USRM, which stands for Underwriting Standards and Reference Manuals, as well as program-specific guidelines as outlined in the program. So today, I wanted to walk you through the exceptions identified on the one late apartment project and why approvals of same was recommended to the senior loan committee by the multifamily lending team and credit. The exceptions are listed on page 4 of the staff report under section 8. Additionally, they are summarized here in the slide here. There are 3 exceptions for this project. First, you will see the request for deferment of payments to the MIP loan until the earlier of deferred developer fee is paid off or year 15. This request is necessary to meet the equity investors requirement, which is consistent with the current investor market demands. Based on underwriting, the deferred developer's fee will be paid off in year 15. Upon the earlier of repayment of the deferred developer's fee or year 15, the net cash flow split will revert back to 50%, 50-50 split. Second, the MIP loan is more than 50% of the permanent loan amount. And the third exception is that the per unit of the MIP loan is $75,000 per unit, which exceeds the program's limit. Both of these exceptions facilitate the progression of a shovel-ready project without delay, and it also reduces the developer's state tax credit request from approximately $18.8 million to $13.3 million, which resulted in a more efficient use of state tax credits. Next slide, number 8, please. I would like to take a few minutes to explain the two charts that are reflected within section 12 of the staff report. Now, the first rent limit chart, which is the chart that is on the top, outlines the total number of units and bedroom types that will be charged rents based on the respective income limits for underwriting purposes. This chart will always reflect the most restrictive affordability restrictions. In this case, the most restrictive requirements are imposed by tax credits. For example, the chart indicates that there will be 94 units with rents that are determined based on households earning at or below 50% of AMI for the respective bedroom types. There will also be 94 units with rents that are determined based on households earning 70% of AMI for the respective bedroom types. The two remaining units will be reserved for 2 on-site managers and will be restricted at or below 120% of AMI. The average affordability for this particular project is 61% of AMI. The second affordability restriction chart, which is the chart on the bottom, outlines the affordable restrictions that will be required by individual regulatory agreements for each program. For this project, there will be 3 separate and overlapping affordability restrictions. It is important to understand that CalHFA generally includes only the required tax-exempt bond affordability levels of either 1, 20% of the total units at or below 50% of AMI, or 10% of the units at or below 50% of AMI, and 30% of the units at or below 60% of AMI, whichever is applicable. For this deal, the bar is electing to restrict 10%, or is electing to restrict 10%, which is 19 total units, at or below 50% of AMI, and 30% at or below 60% of AMI. Second, CalHFA will also record a regulatory agreement specific to the requirements of the MIP subsidy. This agreement will restrict 19 units, or equivalent to 10% of total units at or below 50% of AMI, 19% at or below 70% of AMI, and the remaining 152 units will be restricted at or below 120% of AMI. Third, the TCAP will restrict 94 units at or below 50% of AMI, and 94 units at or below 70% of AMI. As you can see, the TCAP requires the most restrictive affordability restrictions. Therefore, the rent limit chart on the top mirrors the TCAP restrictions. This concludes the One Lake Family Apartments presentation, and I am happy to answer any questions that you may have.
Hi, Gustavo.
I apologize. Yes, thank you. I think I have missed the first, I think, 2 slides. I apologize for that. Was there any slide in reference to the location, sort of the demographics, the socioeconomics of the location where this development is?
Yeah, so this development, hold on one second. Courtney, if you can go back to, I would say, slide number 2. That shows you an aerial map. This project will be located in Fairfield in Solano County. And pursuant to the TCAC's opportunity map, it is located within a moderate resource area. Does that answer your question, sir?
So what are the more specific socioeconomic characteristics of the community? Do you have that?
Ruth, do you, okay, hold on. Oh, there it is. So there are a couple of matrices that we look at on every report.
Poverty, for example, poverty level, those kinds of things, just basic.
Oh, okay, yes. So that information can be found on section 13 of the staff report. So I'm just going to read that out to you, sir. Central City, whether or not it's located in the central city, the answer is no. Low to moderate census tract, it is located in the upper for that category. Minority census tract, the percentage of that is 64.5%. Is it an underserved area? And the answer is no. And the below poverty line percentage is roughly about 1.02%. And whether or not it is located in the rural area, the answer is no. Does that answer your question, sir?
Yes, somehow, but I don't want to keep us stuck here. I think it's important when we have presentations about projects to highlight that. I mean, one of the things that I care deeply about is not over-concentrating poverty and not exacerbating segregation in our communities. And so I just, to me, at least as a board member, that's an important thing that I would like the staff to present at least one slide.
Yes, sir. Yeah, taking a note of that.
Let me address Gustavo's issue. That's why we are starting to track whether or not it is in a moderate, high, or highest resource area. That is not required, but we have incorporated that into our program specifically for a fair housing and to keep and ensure that we're using a race and equity lens and an access to fair housing. So we've been tracking that throughout the mixed income program, and staff have also been directed to all of our lending programs that we are always looking to see based on the opportunity maps, what resource area are we placing our projects in? So that is something we've implemented into all of our lending programs.
Mm-hmm. Right. Mm-hmm. And then I just wanted to point out for board members that within section 5 of the report, we do outline, the distances, if you will, from typical grocery stores, schools, libraries, public transit, et cetera. So that information is also outlined on section 5 of the staff report.
Any other questions from board members?
I also have a question, please, Tina.
Secretary Ramirez was first. Tina, hang on a second.
Will do.
Thank you. I apologize. I appreciate the detail that was provided in terms of the local resources and services because it helps us better understand sort of the amenities and the type of neighborhood that these housing developments are going into. Of course, the map, the image that we saw seemed to be there's a housing development going into an area where there's really not much all around it. And the closest grocery store is 6 miles away. And so I'm just, sort of thinking how are we reconciling having a grocery store 6 miles away from a housing development where the majority of the households are between 50 to 70%. Are there any sort of concerns for transportation issues, sort of coordination on, around some of the other sort of amenities that are, that will be important in terms of connecting to this development?
Yeah, that is a great question, Madam Secretary. So I do want to emphasize that, the one late family apartment will be a part of a larger one late development, if you will, or master plan. When completed, there will be a lot more homes, over 2,000 homes. There will be retail, shopping, parks, and, recreation areas, as well as a lake in the area. So it is under development.
So, Madam Secretary,
is it a master plan community?
I'm sorry. This is one.
Is it a master plan community?
Yes, it's one piece of a larger master plan.
Yeah, so that's what will happen. It'll get built out. I think Tina was next, Jonathan. Hang on a second, bro.
Madam Secretary, you hit it spot on what I was, my concern, because when I looked at the map, I just thought it felt like in the middle of nowhere. And having lived in one of these facilities, I know how hard it is to travel with groceries and kids. And so I'm glad that that question was answered. The other little question that I had is just in general about the program. If I recall that under this MIP program, there are allocation limits. Are we tracking those allocation limits just in general, Kate? How does that work?
Yeah, Ms. Johnson Hall. Yes, we are. We are tracking them. We track every metric related to every deal that we do on all of our mixed income program deals. And really what we're trying to do is make sure that comparatively that we are in line with other deals being approved by CIDLAC and where we are sort of out of sync why that is. On this deal particularly, we're requesting loan amount per unit that are higher than those that were outlined in the mixed income program. And the reason for that is because what we were trying to do was an efficiency analysis. There are other resources, state resources in this deal, specifically the state tax credits, which bring a huge amount of new capital into the state via the investment in the credits. And so those credits were so valuable. What we wanted to make sure was that no project would be over subsidized with the credits. So in order to, I believe that the credit savings on this deal, when they originally came in, they had requested an additional 18 million state tax credits, which we went back and said was too high. And because this project is one, we think it's important, A, that it be included in the overall development, but also it's shovel ready. It's, it will provide housing. It's ready to go. We made the determination that it would make more sense to give them more mixed income program funding and preserve that 18 million in state tax credits, which I believe went to fund an additional 2 other deals. So that's why you may see a variance. And that's also why, these deals, the size of this deal brings it to the board, but that's also, we want to be really transparent about some of the exceptions to guidelines of the term sheet, the program guidelines, or underwriting policies. But that's why you see it on this one in particular, was we were trying to be very efficient with the state tax credits that went with the mixed income program.
Thank you for sharing, Meg.
Mm-hmm. Jonathan, you got your question?
Actually, just a couple of comments. From the image that was shown in the PowerPoint, it makes the project look like it's out in the middle of nowhere. But if you look at the map on the board packet at page 50, you see that this property is actually right in the midpoint between Fairfield and Vacaville and just northwest of Travis Air Force Base. So it's in a rapidly developing kind of suburban community out in the valley. And in many ways, it's in a very strategic location because it's where those two cities are merging. And it also is on a transit line. So I think that addresses some of the access issues. So yeah, this map, you can see that it's, actually go to the one before. Yeah, so you see it's right between where Fairfield and Vacaville are merging off the interstate corridor. So the other thing that I found intriguing, in my experience back in the last century, when planned unit developments were going in, we built all the high-end housing first and then left any affordable housing as an afterthought. It's really interesting to me that in this case, the affordable housing is probably going to be done sooner. And we're going to start with more moderate income housing before all the single family homes are built around it. And to me, that was just, I don't know, clearly it's not a policy thing, but I just found it refreshing that a large planned unit development is starting on the more moderate income housing rather than starting out with the big for sale single family homes.
Good observation. Thank you, Jonathan. Any other questions from board members or comments?
Can I make one last comment?
Please.
When we're talking about bond finance deals, the goal is to use the bond finance deals as bonds and tax exempt bonds were designed to do, which is to leverage private capital. So to the extent that we can use an efficient source of public subsidy, that's what Kate is talking about. When you put these deals together and it's a bond finance deal, you want to leverage as much private capital that you can bring to the table, which means you want them to be able to repay debt. And you want to limit the amount of public subsidy you're putting into a bond finance deal. And that's what Kate did when she went back and made the developers sharpen their pencil on the number of state tax credits that we're bringing to the deal. It was so that she could leverage private capital and leverage debt as opposed to putting more subsidy that was needed in the project.
Yeah, thanks, Tia. That's perfectly said.
Funny how she knows how to do that. Okay. Any other questions? How about a motion for resolution 20-19? Dr. Mbasi made a motion. Is there a second?
I'll second that.
You'll second that. There's a motion and a second. Melissa, let's do a roll call.
Okay. Ms. Avila Frias?
Yes.
Ms. Avila Frias, yes. Ms. Gallagher?
Yes.
Ms. Gallagher, yes. Dr. Mbasiani?
Yes.
Dr. Mbasiani, yes. Mr. Gunning?
Yes.
Mr. Gunning, yes. Mr. Hunter?
Yes.
Mr. Hunter, yes. Ms. Johnson Hall?
Yes.
Ms. Johnson Hall, yes. Treasurer Ma? I think she's back. Dr. Velasquez?
Yes.
Dr. Velasquez, yes. Secretary Castro Ramirez?
Yes.
Secretary, yes. Let's see. Ms. Sotelo?
Yes.
Ms. Sotelo, yes. Chairman, we have approved resolution 20-19.
Awesome. Right, thank you. Okay, looks like we have, was it 8 or 9 we skipped over? 8, right?
Yes, we're on 9.
Number 9. Okay, looks like Sheena's on again.
Yes, sir. Good morning again, everyone. I am very excited to present Project Jamie Lane to the board as an example of the possible innovative uses for CalHFA's AB 101 set-aside. I also have Kevin Brown here, my colleague, the housing finance specialist, to answer any questions that you may have towards the end of the presentation. Slide number 2, please. Jamie Lane is currently an infill site in the city of Cotati, located in Sonoma County, which is within a disaster recovery area, and also pursuant to the TCAX opportunity area map, it is located in a moderate resource area. The city of Cotati and the Housing Land Trust of Sonoma County, HLT, have partnered to provide affordable homes for purchase to families earning between 81% to 120% of AMI. In other words, this is a model that ties the home purchase to the household's earning power. The city's affordability restrictions will guarantee that the homes will remain affordable at resale indefinitely. Next slide, number 3, please. The site will be split into 5 lots and donated by the city of Cotati to HLT. A total of 5 single-family manufactured homes will be installed within the 5 lots. HLT will identify a qualified home buyer based on a ranking system required by the city's Affordable Housing Agreement. HLT will work with the qualified buyer to obtain a community land trust loan through Fannie Mae. The qualified buyer will lease the land from HLT and purchase the improvements using proceeds from the Fannie Mae loan. The home buyer is able to sell at any time in future and can potentially use their accrued equity to purchase a market rate home. HLT will then identify a new qualified buyer to purchase the home on Jamie Lane. To date, HLT has proven this model by completing 101 sale of new and or rehabilitated homes, including 16 resales that did not require any additional subsidy. Next slide, number 4, please. Unique to this transaction is Fannie Mae's recent waiver that allows the combination of their Community Land Trust Program and MH Advantage Program for the financing of new modular housing. This pairing will accelerate the construction of affordable homes available for purchase to families in need. Next slide, 5, please. HLT strives to house families that have been displaced by the destruction of their homes by the recent and continuing wildfires in the Sonoma County area. The cost to rebuild homes in these areas is substantial, particularly in the city of Cotati. The combined grants and contributions from the County of Sonoma, City of Cotati, and CalHFA will be used to help pay upfront costs that would typically be passed on to the qualified buyers, such as engineering, architectural consulting fees, permits and impact fees, and site work. These contributions have lowered the initial below market sale price from $661,000 to approximately $391,000 per home. Next slide, number 6, please. CalHFA has structured its contribution as a purchase of affordability restrictions. Essentially, we will be providing $875,000 to HLT in exchange for recording restrictions on the land, requiring it to be used for affordable housing for the next 99 years. This equals to $175,000 per home and is consistent with HCD's MHP program maximum per unit limit. CalHFA's affordability covenants will be junior to the city of Cotati. The city will perform annual monitoring to assure the homes continue to be sold to families earning between 81% to 120% of AMI indefinitely. Next slide, number 7, please. And now I would like to introduce you to Ms. Deb Goshes, Executive Director of HLT of Sonoma County, to speak a little bit more about the program concepts and partnerships, what has been done before, and provide an overview of this model and impacts on home ownership, and what are HLT's strategies to expand this home ownership partnership model. Next slide, number 8. And Deb, you're up.
All right. Thank you, Sheena. Good morning, or good afternoon, almost in 2 minutes, Chair Gunning and members of the board. Thank you for the opportunity to present today. Housing Land Trust, next slide, please, Sheena. Housing Land Trust partners with local government to increase the supply of affordable housing. Our goal is to lessen the burden of government by serving as adjunct staff, helping to achieve the housing goals. We are the link between cities, developers who must fulfill their inclusionary housing obligation, and employers who need to recruit and retain the local workforce by offering housing through Housing Land Trust. Next slide, please. Housing Land Trust partners with cities throughout Sonoma County, from Petaluma to the south of the county to Cloverdale in the north of the county. Next slide, please. Thank Thank you. Our workforce cannot afford homes that are available, and the inventory of market rate homes is low. Due to the fires and high cost of land and construction, we have a housing shortage of 7,000 and climbing. Our program creates homeownership opportunities that translates into housing security while balancing personal and community wealth. Next slide, please. This is a working subsidy retention model. The one-time public and private subsidy makes the home as affordable to subsequent buyers as it was to the initial buyer. Housing Land Trust stewards both home and families. We protect the investment that has been made that strengthens the fabric of our community. Next slide, please. Jamie Lane is a prototype model for disaster areas. The strategy is to use underutilized land, partner with local, regional, and state government, plus use the MH Advantage product to equal a home that is affordable to our workforce in perpetuity. We plan to share this model through a white paper and educational tools in partnership with Fannie Mae so it can be replicated nationally. In Sonoma County, we're already in the planning stages of replicating this specific prototype in the city of Petaluma. Next slide, please, and thank you so much, Sheena.
Okay, before we conclude the presentation, I do want to share a little bit about the social economics of this area. So the below poverty line percentage is roughly about 14.56%. Minority census tract is about 47%. And again, this project is located within a moderate resource area pursuant to TCAC's opportunity area. And this information can be found on section, again, 13 of the staff report. So that concludes our presentation, and we would be happy to take any questions from the board.
This is Kate, and I just want to say thank you to Dev. When I first met with Dev and Tia, I think it was before Christmas last year, she convinced me in one sitting that this would not be difficult to do and that we should totally step up. And it wasn't difficult, but we really had to think creatively about how to get this deal done and how to make a meaningful investment in the long-term affordability of this. So, Deb, thank you so much for your patience with us and your partnership. It has absolutely been a joy to work with you.
Likewise, thank you.
And she clearly has experience in land trust, right? She knows what she's doing. Thank you.
Oh my God, she is like the national expert in land trust. I have to tell you, Deb, I think Deb and I probably started literally looking at this, trying to figure this out probably 5 or 6 years ago. And we first needed to move the needle on ensuring that CalHFA financing could be paired with community land trust. So we got through that hurdle. Then we wanted to make sure CalHFA financing could go with manufactured housing and that we could pair all that together. And so what the goal was really is to create an alternative form of home ownership that we could lean into, bring all the partners to the table so that we could really serve that broad range of housing types from 30% AMI to 120, so that we can have move-up housing, whether it's you start off as a rental and now you have a move-up housing. In the future, what I would like to see is community revitalization plans that include multifamily, broad range of housing and alternative home ownership models, all as part of a master plan. So that in that community, You can have 30% AMI all the way to 120% AMI with a mixture of income so that people can have self-sustainable lives and have move-up opportunities. That is just something that is just passionate for me. And Deb, I love you, girl.
I love this process. Neutral. Thank you. And can I just say, what an honor and a pleasure it always is to work with you and Sheena and Kate and Kevin. Oh my gosh, if I didn't talk to Kevin once a day, I was missing something in my life. So we're just beyond thrilled to have this opportunity, and then to bring it to disaster areas, you know, around the country, and to really share this. So thank you.
If your next thing is to get the governor at the groundbreaking.
I think there's a few people on this board that can do that. Awesome. Any other comments or observations from members of the board? Great idea, great program. I've been trying to figure out how to do land trust for a decade. Glad to see you guys doing it here. Okay. Draw everyone's attention to the regular reports from multifamily, single family, the bonds that are part of this. Any other closing comments from board members before we turn to the public? Okay, seeing none. Courtney, are there any members out there of the public that want to speak?
Yes. Vivian, if you unmute yourself, you can go ahead and provide a comment for the board.
Hi, I'm thankful. I'm thankful for the opportunity. I'm also a NACA member. I was listening just through the, you know, the regular telephone line, and then I just recently joined because I couldn't make a comment just by listening over the telephone. I heard previously other members asking for resources and stating their concerns about being outbidded and things like that. I don't want to speak out of turn because I don't know if it's going to happen towards the end of the meeting, but will resources or answers to the questions that were stated earlier, will they be addressed at the end of the meeting?
So during public comment, we don't have discussion. So if the caller wants to put something in writing and we can have single family programs get back to her, that would be the appropriate way to do that.
Okay.
Good idea.
All right, thank you.
Thank you, Tia. Good idea. Courtney, any other public comment?
No more comments.
Awesome. I think our next meeting is scheduled for November, but Melissa tells me beware because it could come up. But certainly appreciate everyone taking the time today. Good meeting. I felt like we covered a lot. And unless there's other comments, let's go to lunch. All right. Thanks, everybody.
Thank you.
Bye-bye.
Bye-bye.
Bye.
Bye-bye.
Thank you.